Late last week, Congress passed and the President signed an extension for several tax provisions through December 31st, 2014. One of those relating to agriculture was the $1 per gallon biodiesel credit. Another deals with depreciation. Tina Barrett from Nebraska Farm Business Inc. joined us recently to discuss the extension of Section 179.
Yeah, that's the big thing in this bill that relates to farmers. So Section 179 is back. Again, that's just the expense election we have to write off capital purchases in the first year. So we've had that for quite a while. It's always been in tax law, but we're back at it. We're using $500,000 of it instead of $25,000 that we were thinking.
And the bonus depreciation?
Bonus is back as well. So let me go. This little difference between bonuses. Both are accelerated depreciations. 179 works on new or used property, must have a life class of less than 20 years. Bonus depreciation is only new property. So I always say plastic on the seat's kind of new. It has to be, you have to have first use of it. But it's life class of 20 years or less. So there's a big difference in that 20 years or less and less than 20 years in the fact that farm buildings qualify for machine shed or for bonus depreciation. So if you put up a farm building this year, that's going to be big.
Now we realize that we're late in December talking about this. Do you need to have bought it or do you need to have it in possession?
So the definition of it needs to be placed in service or available for use. So combine needs to be on your place in order to really technically be able to deduct it. Building needs to be up and available for use. Like a pivot, you might not be going to use it. As long as it can make a circle, now you're okay. But in a pile at the edge of the field would not be placed in service.
January 1 reverts back to what?
Back to no bonus and $25,000 of 179 as long, and the purchase limit, which we don't talk about a lot, is $200,000. So if you spend more than $200,000 next year, you don't even get to use the 179, the $25,000. With the increased limit of $500,000, we have a $2 million purchase limit, and most people can kind of stay under that one.
I think when we talked last time, we talked about the dichotomy between crop and livestock producers this year. When is it smart to use this?
Yeah, well, I think in either case, we need to step back when you're making purchases and think about it from a management standpoint first, because it doesn't make sense to spend $100,000 on anything just for a $30,000 tax write-off if you don't need it. So think about it, all your purchases from a management standpoint first, and then we make a decision on how that affects our taxes. But regardless, we're taking an expense that you're maybe going to pay for over the next 7 years. And taking it all today. So we need to think about things like if you're going to finance that asset, you got to make principal payments in the next couple of years. The only offset that you would have in the future for that is depreciation. If you take it all today, you're going to be needing to generate higher taxable incomes in the future in order to cash flow. So think about it if you're financing it. All those kinds of things are big, but the crop guys are going to be looking at things a little different than the livestock guys this year. Most of the crop guys have spent everything that they've wanted in the last few years, and we're looking at lower incomes coming forward when we need to make those payments. So it maybe isn't as smart to go out and do that this year as it has been in the past. Livestock guys, on the other hand, the first time we've got some cash laying around, and using this to upgrade equipment, maybe improve the breeding herd, those kinds of things, are all good choices, again, as long as it makes sense in your management plan. As
we get ready for 2015, you said one of the things that's maybe important to keep in mind is inventory carryover. In what sense?
Right. Well, I think, and from a livestock standpoint, we can look at the crop guys and what they've done for the last 4 or 5 years and maybe learn some lessons. But some of the crop producers have carried over tons of inventories and built huge amounts trying to avoid taxes. And now we're coming into a place where we need to keep paying taxes at that higher level because we've pushed so much inventory forward. And now there's not going to be as much profit to use to pay those taxes. So maybe just don't be afraid of paying some taxes. We don't want to pay more than you need to, but as profitability goes up, your tax liability is going to go up.
Now we know that costs of production are going up for crop producers, at least the margins are getting tighter, I guess I should say. When you look at 2015 cost of living, reiterate to me where it is right now and why that's important.
Yeah, well, for 2013 we saw an average cost of living of about $100,000 plus another $40,000 for income taxes. And then if we factor in things like non-farm capital purchases, other things like that, on average the producers took out about $200,000 from the farm. And which is fine when we were making money. The question is it going to be something that can be pulled down? And we've looked at our numbers since 1977, and family living has never decreased in that time period. maybe $100 or something, but so we have some steady, but never a significant decrease. So it's going to be very interesting as to see if that is something that can pull down when profitability comes down, or if we're at a new level. Because if we're looking at farm incomes of 40,000 and family living at 100, you know, we're going to be going backwards pretty fast.
On the Market Journal website, we'll link to Tina's recent Crop Watch article about the extension of tax provisions.